Supermicro gained 4.2%. Our score is 43. Caution. The engineering giant is racing to ship 2,000 liquid-cooled racks monthly to dominate AI data centers. Yet, this complex plumbing hardware has squeezed gross margins down to 11%. Our full teardown reveals whether this massive hardware shift is a structural mode or a margin trap. The market panic isn't about legal risk. It's about who can actually cool the next-gen rack. Marshall Wass kicked off a 1.2% stake and UBS added 63% to bring its holding to 2% of Supermicro, a $19 billion company, signaling aggressive institutional accumulation. Supermicro closed up 4.19% at $29.33 after an intraday 8% dip sparked by expanding police raids in Taiwan, while retail traders fled the stock. Smart money is buying the cooling edge. The GB200 NVL72 rack packs 72 GPUs and can demand up to 120 kilowatts per cabinet, a density where air cooling collapses. Supermicro's proprietary direct-to-chip liquid cooling system moves liquid directly over the die and sustains 100 kilowatts per rack, outpacing Dell's 40 kilowatts limit. Cooling capacity is the real moat. That thermal advantage lets integration partners ship liquid-cooled racks immediately, neutralizing the legal headlines and justifying the long-term bet. The hardware story beats the hype. Quarterly financials showing modest revenue momentum for Supermicro. By Q4 2026, a hawkish Federal Reserve monetary policy and escalating trade tariffs will compress Supermicro's operating margins by at least 150 basis points. While Marshall Wass is accumulating, the macro environment is shifting to friction. A Fed rate of 3.63%, combined with a normalizing yield spread of plus 0.28% raises the cost of capital for hardware-heavy balance sheets, even as recession risk sits at 8.7%. Furthermore, tightening U.S. export controls on high-performance silicon restrict shipments of liquid-cooled platforms to Chinese hyperscalers. This regulatory friction directly threatens Supermicro's historical 122.7% revenue growth. Geopolitical friction acts as a violent wave against Supermicro's supply chain. The company's deep manufacturing reliance on Taiwanese ODMs, like Abelcom, exposes it to severe disruption as Taiwan raids expand. This vulnerability is compounded by escalating protectionist trade wars and potential Greenland-style tariffs that threaten global foundry logistics. Socially, political backlash against big tech's massive energy footprint is accelerating regulatory scrutiny over data center power consumption. With a high beta of 1.87, Supermicro's valuation remains highly sensitive to these geopolitical shocks. Smart money is positioning for this volatility, recognizing that hardware-heavy balance sheets must absorb these rising international choke point costs. Supermicro server integration is trading below its 20-day average. The top site's narrative isn't about scale. It's a legal firewall. Management's headline: large-scale installations in top sites. 3 words that hit every earnings call. What the lab hears: we're not naming names because some are under U.S. export scrutiny. The Taiwan raids and $2.5 billion NVIDIA smuggling case? Not in the 8K. The stock chart is: SMCI dropped 8% the day the news broke. Insider trading pattern? Gone. No buys, no sells, just silence from executives who traded like clockwork until now. That's not confidence. That's a legal lockdown. Institutions see what retail misses. Marshall Wass took a 1.2% stake. UBS added 63%. BlackRock's 7.2% holding stayed put. These aren't momentum plays. They're betting on the backlog, not the headlines. Retail, meanwhile, screams dilution panic over the $7 billion raise. What the lab hears: management is pre-funding growth before margins compress. R&D spiked 37% YOY. As a percentage of revenue? Flat. That's not pipeline expansion. That's playing defense. Charles Leong: supply constraints troublesome. Challenges just not at the same elevated level. That's not progress. That's a downgrade in urgency. The Q&A tells the real story. Catherine Murphy asked about a delayed large customer. David Wigan pivoted to diversification and better margins. No numbers, no timeline. Spin doesn't ship servers. The momentum breakdown for Supermicro. RSI sits at 33, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Supermicro's bull case rests on the transition to dense liquid-cooled clusters. Integrating NVIDIA's GB200 NVL72 architectures positions Supermicro to capture dominant share in the Blackwell deployment cycle, leveraging its proprietary direct-to-chip liquid cooling to solve critical thermal density limits. But persistent gross margin pressure and customer churn break the bull thesis. If internal accounting audits lead to financial restatements or a NASDAQ delisting, the bull case evaporates. Morgan Stanley's 32% trim confirms institutional distribution, while an elevated short float of 19.4% shows heavy market skepticism. The core question is this: can Supermicro defend its speed-to-market mode as major cloud providers transition to direct ODM buying? The lab's answer is no. This transition commoditizes the integration layer. Smart Money is positioning for the upcoming S&P 500 index inclusion, which forces passive inflows, temporarily targeting the $35 level. Our hold call at $33.91 proved correct, with the stock declining 13.5% to its current price of $29.33. Our AI score of 43 out of 100 reflects low conviction. If Supermicro resolves its audit by Q3 2026, index inflows will drive the price toward resistance at $50.17. If audits drag on, expect a breakdown past support at $27.78 toward the annual low of $19.48. We expect the downside path to play out. Here's the macro picture shaping Supermicro. Tightening U.S. export controls on high-performance silicon directly restrict SMCI from shipping customized liquid-cooled HGX H100 and H800 platforms to Chinese hyperscalers like Tencent and Alibaba. This regulatory barrier forces a heavy reliance on domestic North American enterprise clients, while raising supply chain vulnerability due to SMCI's deep manufacturing dependence on Taiwanese ODMs like Ablecom. The massive industry transition toward dense liquid-cooled AI clusters is driving unprecedented demand for SMCI's rack-scale plug-and-play solutions integrating NVIDIA GB200 NVL72 architectures. As high-bandwidth memory and advanced packaging thermal densities soar, SMCI's proprietary direct-to-chip liquid cooling technology positions it to capture dominant share in the next-generation Blackwell deployment cycle. The primary near-term upside catalyst is the rapid margin expansion from volume shipments of fully integrated liquid-cooled racks to Tier 1 cloud service providers. Conversely, the most critical downside risk stems from persistent gross margin pressure and potential customer churn if ongoing internal accounting audits lead to prolonged financial restatements or NASDAQ delisting. SMCI's profit margins are crumbling as component costs surge, driving immediate price weakness. Not financial advice. Do your own research.